Welcome back to the channel, or if you're new here, thank you for joining. It's January 2026, and with the new year comes a fresh wave of people ready to take control of their financial future. Markets are volatile as always. We've seen tech rallies, interest rate shifts, and plenty of headlines creating fear and excitement. But if there's one person whose advice has stood the test of time through every economic cycle, it's Warren Buffett. The Oracle of Omaha has built Berkshire Hathaway into a hundreds of billions powerhouse, not through flashy trades or hot tips, but through simple, disciplined principles he's shared openly for decades in his annual letters, CNBC interviews, and shareholder meetings. Today, we're diving deep into 5 of the biggest investing mistakes Warren Buffett repeatedly warns beginners to avoid. These aren't my opinions or trendy 2026 takes, they're drawn directly from Buffett's own words and track record. We'll explore each mistake in detail, what it is, why it's dangerous, real examples from history or Buffett's career, and practical steps to avoid it. By the end, you'll have a clear roadmap to invest more like Buffett and build real lasting wealth. Let's get started. The first major mistake beginners make is trying to time the market. So many new investors believe they can predict short-term movements, buying when they think stocks are about to surge and selling before a drop. They watch CNBC, follow Reddit threads, or chase economic indicators, convinced they can outsmart the crowd. Buffett has been uncompromising on this for years. One of his most famous quotes is, "Our favorite holding period is forever," but he also says, "We do not view Berkshire shareholders as a group, as a bunch of traders who want to time the market." In his 1996 letter, he wrote that attempting to time the market is futile because no one can consistently predict it. Why is this such a trap? Because even professionals get it wrong most of the time. Studies show that missing just the best 10 days in the market over decades can halve your returns. Buffett's proof is in his performance. He's endured crashes like 1973 to 74, Black Monday in 1987, the dot-com bust, the 2008 financial crisis, and the 2022 bear market. Never selling out in panic, but often buying more. For example, during the 2008 crisis, while others fled, Buffett invested billions in Goldman Sachs and Bank of America at bargain prices. The fix for beginners in 2026? Adopt dollar-cost averaging. Invest a fixed amount regularly, regardless of price. Time in the market, not timing the market, is what compounds wealth over decades. The second mistake is investing in businesses you don't understand. What Buffett calls operating outside your circle of competence. Beginners get FOMO from hot sectors. In past years it was crypto or meme stocks. In 2026, it might be advanced AI, quantum, computing, or whatever's dominating headlines. They pour money in without grasping the fundamentals. Buffett's rule is ironclad. Never invest in a business you cannot understand. He said, "If we can't understand it, we don't invest in it." A classic example is his early avoidance of tech stocks. For decades, he stayed away from Silicon Valley darlings because he couldn't confidently predict winners in such fast-changing industries. He even joked about missing Amazon and Google early on. But once he understood Apple's ecosystem, its brand moat, customer loyalty, and cash generation, he made it Berkshire's largest holding, buying heavily starting in 2016. Today, it's worth over $150 billion for Berkshire. The danger of stepping outside your circle. You can't assess risks properly, leading to massive losses when hype fades. How to avoid it? Start small and honest. Ask yourself, can I explain how this company makes money, who its competitors are, and why it has a durable advantage? If not, skip it. Build your confidence gradually by reading annual reports and sticking to simple, familiar industries like consumer goods or banking. The third mistake that's quietly devastating for beginners is paying excessive fees. Wall Street, really loves complexity because it generates revenue, management fees, trading commissions, advisory charges, hedge fund cuts. Buffett has railed against this for years. In his famous 2005 bet, which was resolved in 2017, he wagered $1 million that a simple S&P 500 index fund would beat a basket of hedge funds over 10 years. He won handily. The index returned about 125%, while the hedge funds averaged just 36% after fees. In his 2016 letter, he explained how fees compound against you. A 1 to 2% annual drag seems small, but erodes half your potential gains over decades. Beginners often fall for expensive active mutual funds, robo-advisors with hidden costs, or expert newsletters promising outsized returns. In reality, after fees, over 80% of active managers underperform the market long-term. Buffett's recommendation is crystal clear. The best way for most people to invest is in a low-cost index fund. Something like Vanguard's VOO or VFIAX, with expense ratios under 0.05%. In 2026, with markets maturing and more low-fee options available, there's really zero excuse. Avoid this mistake by going passive buy and hold broad indexes. Minimize trades to cut commissions and taxes and let compounding work without Wall Street taking its cut. The fourth mistake is letting emotions dictate your decisions, succumbing to fear and greed. This is just human nature amplified by 24/7 news and social media. When markets soar, greed pushes beginners to pile in at peaks. When they crash, fear triggers panic selling at lows. Buffett's timeless advice: be fearful when others are greedy, and greedy only when others are fearful. He's lived it through every cycle. In 2008, while the world panicked, he wrote an op-ed titled, "Buy American, I Am," and deployed capital aggressively. More recently, during the 2020 COVID crash, Berkshire stayed calm and opportunistic. Emotional investing leads to the worst outcome: buying high, selling low. Behavioral finance studies confirm investors underperform markets by 4 to 5% annually due to bad timing driven by feelings. The solution? Build a written investment philosophy based on facts, your goals, risk tolerance, and rules like never sell a great company unless fundamentals deteriorate. Rebalance mechanically, turn off notifications, and view dips as sales on quality assets. Discipline over decades is what separates wealthy investors from the crowd. The fifth and final mistake is trading too frequently, treating stocks like lottery tickets instead of ownership in real businesses. Buffett famously said his favorite holding period is forever, and if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. His portfolio reflects this. Holdings like Coca-Cola since 1988, American Express for decades, and Apple are barely touched. Turnover at Berkshire is often under 5% annually. Beginners chase quick wins, day trading or flipping hot stocks, racking up short-term capital gains taxes, which are higher rates, and commissions. Data shows frequent traders underperform buy and hold by massive margins. Long-term ownership lets great companies reinvest earnings, grow intrinsically, and compound tax-deferred. In 2026, with apps making trading addictive, this trap is bigger than ever. Avoid it by thinking like an owner. Buy pieces of wonderful businesses at fair or better prices, ignore daily quotes, and hold through volatility as long as the thesis holds. Wrapping this up, these 5 mistakes: market timing, investing beyond your understanding, high fees, emotional decisions, and excessive trading, explain why most investors lag the market. Warren Buffett's alternative is straightforward and powerful. Invest in what you know, keep costs minimal, stay rational, and hold patiently. In 2026, with uncertainty around rates, geopolitics, and innovation, these principles are more valuable than ever. Start small, stay consistent, and compounding will do the rest. If this deeper dive helped clarify Buffett's wisdom for your 2026 investing, give it a like, subscribe for more no-hype breakdowns of timeless strategies, and comment below. Which of these mistakes have you made, or which one are you focusing on avoiding this year? Drop your thoughts. I read them all. Thanks for watching. Invest wisely, and I'll see you in the next video.